My name is Cheng Boon. Today I will present about my individual assignment, which is the forecasting the price of gold using time series model. Task 1, time series exploration and decomposition. The objective of this project is to forecast daily gold prices using time series forecasting methods. The dataset contains 1,718 daily observations from December 2011 until December 2018. I used the adjusted closing price because it reflects the actual value after stock adjustment. For time series exploration, looking at the gold price chart, we can see three main patterns. First, there was a strong downward trend from 2012 to 2016, where prices dropped from about 170 to below 110. Then we saw a recovery from 2016 to 2018, with prices climbing back to around 130. We also noticed that volatility trend to cluster during crisis period. The STL decomposition also showed that there is almost no seasonal patterns, meaning seasonal effects are very weak in daily gold prices. ACF and PACF analysis for the autocorrelation function, we saw that the leg 1 autocorrelation is extremely high at about 0.99 and it decays very slowly all the way to leg 14. This confirms the series is not stationary with strong persistence. For the partial autocorrelation function, we also saw a very high value at leg 1, but then a sharp drop afterward. This suggests an AR1 process, which is consistent with a random walk behavior. Task 2, stationarity and data preparation. For the stationarity testing, since ARIMA models require stationary data, I performed the augmented Dickey Fuller test. We got negative 1.823 for the test statistic. The p-value was 0.369, which means the original series is not stationary. Therefore, I apply log transformation followed by first differencing. After transformation, the series fluctuates around zero and becomes suitable for forecasting. For the ACF and PACF analysis, after applying log transformation and differencing, the ACF now decays quickly with most autocorrelations between the confidence interval, which means the long-term dependency has been removed. The PACF also shows that only early legs are significant, while later legs lost significance, indicating we only need a low auto-regressive order. So I split the data chronologically, training data from December 2011 to December 2017 with 1,470 observations, and testing data on all of 2018 with 248 observations. As you can see in the table, random splitting creates look ahead bias, which is invalid for time series. Chronological splitting is the standard practice because it is realistic and valid for real-world forecasting. Task 3, building three forecasting models. First one, the Naïve forecast model. The Naïve model is simple benchmark. It predicts tomorrow price is exactly today closing price. It need no calculations or fitting, and it is the standard reference for assets like gold that we have like a random walk. Every other models perform will be measured against this baseline. The second, Holt linear exponential splitting, which extends simple exponential splitting by adding a trend component. The model estimates two parameters, alpha for the level and beta for the trend. We got an alpha of 0.9377, meaning the models put heavy weight on recent observations, and a beta of 0.0, confirming that no significant trend was detected. The Young box test gave a p-value of 0.5383, which is greater than 0.05, so we can conclude the residuals behave like white noise and the model capture the dependencies well. The ARIMA model have three components: P for auto-regressive order, D for differencing order, and Q for moving average order. For the ARIMA model, we selected ARIMA 111 based on our SCF and PSCF analysis. The AR1 was 0.2605. The MA1 was negative 0.3226. The variance was 1.7414. To validate the model, we performed the Young box test, got a p-value of 0.9980, which is greater than 0.05, confirming the residues are white noise. The residue plot also show random fluctuation around zero without any patterns. For the fourth, we build a SARIMA model to test if adding seasonal component will improve our forecast. The estimated parameters were AR 0.2985, MA negative 0.3621, seasonal AR negative 0.0018, and seasonal MA negative 1.0072. Notice the seasonal AR is very close to zero, which is confirmed seasonality has little impact on gold prices. Look at the residue diagnosis. The Young box test gave a p-value of 0.0339, which is less than 0.05. So we reject the null hypothesis. This means some autocorrelations still remain in the residues. So the SARIMA models fails to capture all dependencies. In short, adding seasonal components did not improve the model. Task 4: Forecast Evaluation and Comparison. Here is the forecast accuracy comparison table. The Naïve model achieved the lowest error across all metrics, with an RMSE of 0.7391, MAE of 0.5509, and an MAPE of 0.4577%. Holt Linear and SARIMA performed similarly, with RMSE around 4.2, while ARIMA performed the worst with RMSE of 6.17. The key findings here is that increasing model complexity did not improve forecasting accuracy. In fact, the simplest model, the Naïve forecast, performed the best. Actual versus Naïve forecast. This chart compares the Naïve forecast against the actual gold prices. As you can see, the Naïve forecast closely follow the actual movement because each forecast is simply the previous day value, which capture the short-term dependence in the data while it sometimes miss rapid price change. It remains close to the actual value throughout the test period, confirming why it's such an effective benchmark. Actual versus hot linear forecast. The forecast shows some deviation from actual values, particularly in the middle of 2018. While it captured the overall trend accurately, it produced some smoother forecasts compared to actual observations and is slow to respond to sudden market changes. This behavior was expected since exponential smoothing models are designed to estimate the underlying trend rather than react to short-term fluctuations. Actual versus ARIMA forecast. This chart shows the ARIMA forecasting result. Overall, the models capture the general trend of gold prices, but it does not follow sudden changes closely, especially during volatile period. The short area represents the confidential interval, which become wider over time, indicating increasing forecast uncertainty. Overall, ARIMA provide reasonable forecast, but its accuracy is lower than the Naïve model. Actual versus SARIMA forecast. This chart shows the SARIMA forecasting result. Overall, the forecast is very similar to ARIMA. Although SARIMA includes seasonal component, the gold price data has very weak seasonality, so the additional seasonal parameter do not improve the forecasting performance. The model also struggling to capture sudden market changes. Therefore, SARIMA does not provide a significant improvement over the ARIMA model. Actual versus all forecasting models. This chart compares all four models against actual prices. The Naïve forecast with the actual gold price better than any other models. Holt linear underestimate quick market changes, while ARIMA and SARIMA produce both the forecasts that miss short-term movement. These visualizations confirm the numeric result. The Naïve model has the highest forecasting accuracy. There are two common forecasting approaches: one step ahead forecasting and multi-step ahead forecasting. One step ahead forecasting predicts the next observations and update the forecast whenever new data becomes available. Multi-step ahead forecasting predicts the entire testing period at once without update the model. In this assignment, I use multi-step ahead forecasting because it allows a fair comparison of all forecasting models using the same unseen test dataset. Rolling origin evaluation. The forecast closely follow the actual gold prices throughout most of the testing period, showing that the model can effectively track price movement. It also successfully captured the downward trend between June and September 2018, as well as the recovery toward the end of the year. Although small differences appear during periods of high market volatility, the overall forecasting performance remains accurate. Compared with fixed multi-step forecasting, the rolling origin approach is more reliable because the model is continuously updated with new observation. In conclusion, we found that gold prices are non-stationary and become stationary after log transformation and differencing. The Naïve model performed best, while complex ARIMA and SARIMA models could not be it, confirming the gold prices follow a random walk. A key limitation is to only use historical prices and ignore external factors like inflation and interest rates. Personally, I learned that more complex models do not always give better prediction. Sometimes the simplest approach works the best. That's all for my presentation. Thank you.